Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The Federal Reserve stands at a critical crossroads. The March 17th through 18th FOMC meeting is now just 2 weeks out, and markets remain deeply divided on whether we get the first rate cut since this cycle began, or if the Fed holds its restrictive stance. This isn't just another meeting. According to multiple Fed calendar sources, this represents one of Jerome Powell's final policy decisions before his term expires on May 15, 2026, adding what traders are calling transition risk to an already complex macro environment. Let's establish where we are right now. The federal funds rate sits at 3.50% to 3.75%, unchanged since the January 2026 meeting. According to E-Trade's investing editorial, the Fed has characterized this as a cautious pause in monetary policy. But pause implies something comes next, and that's where the institutional divide gets interesting. Goldman Sachs and Morgan Stanley are reportedly in the delay cut camp, favoring a June move. Their thesis centers on labor market resilience and the need for more disinflationary evidence. Meanwhile, Citigroup and Wells Fargo maintain that a March cut is necessary to prevent unnecessary economic cooling. This bifurcation among top-tier institutional strategists tells you everything about the uncertainty premium baked into current positioning. Now let's talk inflation, because this is the central tension. According to AI Invest's Fed policy analysis, headline CPI for January 2026 declined to 2.4% from 2.7% in late 2025. That's progress. But core personal consumption expenditures, the Fed's preferred gauge, remains elevated near 2.8%. That stickiness is concentrated in housing and services, the exact categories the Fed watches for persistent price pressures. You've got headline inflation moving toward target while core measures refuse to cooperate. That's the dilemma. The labor market adds another layer of complexity. Unemployment ticked down to 4.3% in January, beating the 4.4% expectation. But monthly payroll additions have moderated to approximately 60,000 jobs. According to J.P. Morgan's January Fed meeting analysis, this represents resilience without overheating. The question is whether this moderation is healthy cooling or the early stage of something more concerning. Let's get into what this means for positioning across asset classes. Start with equities and specifically the technology sector. Microsoft, Apple, NVIDIA, these high-growth names are discount rate sensitive. Any dovish pivot increases the present value of future cash flows. If the Fed cuts 25 basis points in March, you're looking at a potential spring rally in growth stocks that have been range-bound on rate uncertainty. The math is straightforward. Lower rates mean higher equity valuations, particularly for long-duration growth assets. Banking tells a different story. J.P. Morgan Chase, Bank of America, the rate-sensitive institutions that thrived in the higher-for-longer environment now face compressed net interest margins if rates decline. According to Bankrate's analysis of Fed impacts on investments, banks will need to pivot toward fee-based revenues and increase lending volumes to offset margin pressure. The deposit cost relief from lower rates provides some cushion, but the structural challenge is real. Watch how regional banks trade around the FOMC decision. That's your tell for institutional sentiment on banking sector profitability. Fixed income is where the action gets technical. iShares currently offers yields in the 4.5 to 6.5% range across different fixed income strategies, according to their Fed Outlook report. Short-duration instruments like the iShares 0 to 3-month Treasury Bond ETF, ticker SGOV, are attracting flows as investors employ bond laddering strategies. The calculus here is that even if longer-term Treasury yields stay stable due to supply and demand dynamics, lower short-term rates incentivize portfolio rebalancing toward fixed income diversification. If you're running a balanced portfolio, this is the rotation moment you've been waiting for. Real estate and infrastructure sectors are critically sensitive to this decision. Prologis, American Tower, these REITs and infrastructure plays are watching refinancing costs closely. A 25 basis point cut provides meaningful relief on financing pressures and helps stabilize commercial real estate valuations. According to MLQ's market brief from March 2nd, defensive sectors have been bucking the Fed pause trend, suggesting institutional money is already positioning for rate relief in real estate. Now let's talk risk management, because this environment demands precision. According to Economic Times reporting on bond investor positioning, market participants are bracing for a prolonged Fed pause while cautiously adding risk. That phrase, cautiously adding risk, encapsulates the hedging approach. You've got robust core inflation coexisting with stable employment, a bifurcated macro setup that requires nuanced interest rate exposure management. Portfolio managers are monitoring critical price thresholds in Treasury yields, while gauging potential sector rotations between equities, banking, and real estate. Here's the central tension that every trader needs to internalize. If the Fed cuts in March, it risks appearing over-accommodating in the face of latent inflationary pressures. If it holds, it risks over-tightening into a slowing labor market. That's the tightrope. And it's made more complex by the leadership transition. Powell's final months introduce uncertainty about policy continuity under new leadership in the latter half of 2026. Let's identify the critical data points between now and the FOMC decision. Today, March 4th, the Beige Book drops. This anecdotal evidence from Federal Reserve districts will provide color on regional economic trends. Then March 11th, we get the CPI report. That's the most recent inflation data before the meeting, and it's the single most important input for the Fed's decision function. If core CPI shows unexpected strength, the probability of a March cut collapses. If it softens meaningfully, the doves gain ammunition. According to Charles Schwab's bond market analysis for 2026, the key question for fixed income investors is what could go wrong? Their thesis centers on the risk that the Fed miscalculates either by cutting too early and reigniting inflation expectations or holding too long and triggering an unnecessary slowdown. Both scenarios create volatility, but the directional implications are opposite. That's why positioning around the FOMC meeting requires defined entry and exit points with clear risk parameters. Let's bring this back to actionable intelligence. If you're long growth equities, you're positioned for a dovish outcome. If the Fed cuts, you catch the rally. If they hold, you need defined stops because growth gets repriced on higher for longer expectations. If you're in financials, particularly banks, the opposite trade applies. A hawkish hold benefits net interest margins. A dovish cut pressures them. Fixed income offers the cleanest risk-reward right now. Bond investors are adding duration cautiously, and the yield levels in the 4.5 to 6.5% range provide attractive entry points with rate cut optionality. For real estate and infrastructure, this is a binary catalyst. Rate relief unlocks refinancing opportunities and stabilizes valuations. A continued pause extends financing pressure. Position sizing matters here because the outcome will drive sharp sector rotation. The institutional divide between Goldman and Morgan Stanley on one side and Citi and Wells Fargo on the other tells you this decision is genuinely uncertain. When top-tier strategists disagree this sharply, it signals the Fed itself is wrestling with competing data inputs. That's why the March 11th CPI print is so critical. It's the tiebreaker. One more layer to consider: the transition risk premium. With Powell's term ending in May, market participants are starting to discount uncertainty about the next Fed chair's reaction function. Will the new leadership maintain continuity or shift the policy framework? That uncertainty gets priced into volatility, particularly in rate-sensitive sectors. It's an underappreciated risk factor that could drive dispersion in sector performance through mid-year. Bottom line, the March FOMC decision is a high-conviction catalyst across asset classes. Equities, fixed income, real estate, and banking all face meaningful repricing based on the outcome. The data inputs are mixed, institutional positioning is divided, and the leadership transition adds complexity. Between now and March 18th, watch the Beige Book today and the CPI report on March 11th. Those are your signposts for how the Fed will navigate this crossroads. The setup favors active positioning with defined risk parameters. Whether you're trading equities, rotating into bonds, or hedging rate exposure, the next 2 weeks will clarify the path forward. This is a market environment where precision matters and timing is everything. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.